When people first get into investing, whether it's real estate investing or other types of investments, they often fail to ask what is the time commitment or the timeline for this investment. And our guest today, Tom Shallcross, and I were talking before we hit the record button about velocity of money and how the turnover of your investments really matter, and it can have an special impact on you based on your age and what your investing goals are. So Tom is a Chicago-based real estate investor. He operates over 200 units. He's also the host of the Straight Up Chicago Investor podcast. So Tom, I'm curious to hear your thoughts on how investors should think about their investment turnover, velocity of money, and how some of their investing goals and factors like their age play into that.
Awesome. No, thanks, Brian. Happy to be here. And it's a great topic, and I'll try not to go too long on this because I have a lot of thoughts. But
Good. I'm excited to hear a lot of
yeah,
thoughts.
let's hear it. So I feel like too many times, like people get sent out a deal, whether it's a smaller deal they're going to take down themselves or a syndication, and everyone asks the question of, is this a good deal? And there's usually some very obvious things to say, okay, yes, it's got this metric, this IRR, this cash on cash. But a lot of times when you say, what is a good deal? It's a very subjective question, right? And there's a lot of factors that go into that. And I feel like people just want it to be very scientific. Like, if this, then that. They want it to be like, this checks a box. When in reality, it may be a good deal for someone else. It may be a good deal for you. It may be a good deal for everybody. But a lot of times we don't take in our personal context into that equation. And what I mean by that is, like, how much liquidity do you have right now? What other opportunities do you have, right? The true opportunity cost of where else could you put your money? And as you had alluded to, just the velocity of that money, that timeline to get it back, right? Me, I'm 40. I want to be recycling my money still. I want that money returned to me and not just be sitting out there. I can't just go out there and be like, here's another 100K investment. Here's another 100K investment. Like, you run out of money doing that,
Very
right? The
quickly
money
for
needs,
most of
yeah,
us.
very quickly. The money needs to come back to you in some form. So I look at that. And then let's say you have a white collar job, you're a little bit more established in life, you're whatever, I'm just making up ages, but you're in your mid 60 and you have that treasure chest of, yeah, I have all this ammunition here. Those types of investments where you just put the money out there and you get a 7%, an 8%, whatever it is, and you don't worry about the money coming back. It's just better than what you're getting in the bank, plus all the benefits of real estate. That makes perfect sense for that person. And everyone wants to read, what makes a good investment? What do I do? And a lot of it is contextual. What are you looking to do? What are you looking to get out of this? What are some of those personal goals you have? And as I mentioned before, just what are you working with? Meaning, what liquidity do you have, and what are the other options if you didn't do this deal? I'll pause there, but those are just at a high level, just some of the things that I feel don't get factored in. We try to make it more binary when in fact I can't think of the right term, but let's say three dimensional.
Yeah, that's something that I was just writing a newsletter for our audience this morning about this, how so many investors really think two-dimensionally about investments. They just look at risk and returns. And they're like, oh, what's the risk versus the returns? There are so many other dimensions to investments, such as liquidity, such as the time commitment of an investment, such as your personal values. The example that I gave was, if you look at upstream oil drilling, historically, it's returned 15 to 20% returns with pretty low volatility and pretty consistent, way better than the S&P 500, for example. But that doesn't jive with a lot of people's personal values. There are all of these other factors at play that determine what makes a good investment for you personally. Stocks have a lot of liquidity, but they're also super volatile. There's all of these other components. So we, in our co-investing club, we really encourage our members to think three-dimensionally about how an investment fits for them, because as you alluded to, personal finance is personal. It's based on your personal goals, and there's lots of right ways to invest for different people. But what is right for me may not be what's right for you, and vice versa. So, yeah, these are all kind of recurring themes that we come back to with our audience, and that I think a lot of investors just don't quite get right when they're first starting out in particular.
Yeah, and then I'll piggyback there and say it's also important to take a step back and look at the overall investment, because like you and I can go look at the same thing and just based on our assumptions, like, all right, we'll have this amount of rent increase or this amount of taxes will go up this amount. We can underwrite the same thing and yours might come out at like 16% IRR and mine might be 20, right? And you're right, people get so caught up in, oh, this is 18, this is 16, this is 12, this is whatever. And it's a lot of it is just you're making assumptions about years down the road that no one really knows. So taking a step back and being like, at a macro level, do I like this operator? Do I trust this operator? Does he or she have the track record? Is this a location I want to be in? What's my floor here? Everything hits the fan. What's my downside? And I think looking at it more at that macro level as opposed to just getting so in the weeds of, oh, is it X or X plus one? You're making assumptions. It's not some super tangible thing. And we want to make it tangible because that's the way our brains think.
Yeah, so you raise a really good point about how projected returns are basically made up. They depend on hundreds of individual assumptions, from projected insurance cost increase to and 100 other things. So we really emphasize that same message to members of our co-investing club: is focus on the operator first. Is it someone who you really trust to deliver well for you as an investor? Bet on the jockey, not the horse, if you will, to use that overused analogy in this space. But we really, that's what we've seen over and over again, is that a great operator can salvage a deal that has gone sideways, and vice versa. A bad operator can totally mess up a perfectly good deal. So yeah, the operator really has to come first. And the deal, it's not that the deal is irrelevant, but it is certainly not as important as finding operators who you really believe in, both their experience and their skill level, and also their ethics, or that's the wrong way of putting it, but their trustworthiness in looking out for your interests ahead of their own.
Yep, no, absolutely. Couldn't agree more.
Tom, in 30 seconds or less, how do you help people, and how can people connect with you if they want to take you up on that help?
Sure. I'm open. Like you can link to my contact info. I'm happy to always have conversations. As you said at the beginning of the podcast, I co-host the Straight Up Chicago Investor podcast. So we can link to that, but we have a ton of free resources on that site. It's something that we've been doing for over 4 years now, and it's something we're going to continue to do. And everything is free. All the content out there, it's there, it's at your fingertips, and we want to get out to as many people as possible.
Awesome. Tom, thank you so much for joining us today. And guys, if you enjoy these quick, focused conversations that we have, please rate and review the show. It makes a world of difference to us. And on that note, we will catch you next time. Want the cash flow, appreciation, and tax benefits of real estate without becoming a landlord? You've heard of REITs and real estate crowdfunding, but you probably don't know much about 5 other ways to invest passively in real estate. So we put together a free video course for you to show you how to consistently earn 15% plus returns from 5 lesser known, hands-off ways to invest in real estate. And even more importantly, we'll keep risk front and center in that whole discussion, because really, what's the point of investing for high returns if you also take on high risk, right? So visit sparkrental.com/free to take our free course. Each video is snackable at 10 to 15 minutes long, and the entire course takes less time than watching a movie. Looking forward to chatting with you from within the course.